Welcome everyone to the part 2 of the two-parter commentary series on how to pitch your product. And now for this week, we have a workshop on how startups raise capital. So just diving in real quick, why raise money? You need to raise money when you are ready to scale insanely fast, when you have a plan on how to spend it, your company has 1,000 times potential, and you see a reasonable exit in 5 to 10 years. So what does it really mean to scale insanely fast, right? So let's say you have a company right now, right? You are at 1,000 users on a social messaging app. If you have 100,000 users flood into the app the next day, can you pay for the app? Probably not. So that means you're going to need to beef up your AWS plan. That means you're going to need to horizontally scale as well. You're going to need to pay a lot more engineers, maybe pay a few designers to build out that UI. You need to scale in terms of what you have in terms of resources and the horsepower that you have down the line too. You also really do need a plan for it. I know there have been what was it? I don't want to say the names explicitly, but there have been I'm just thinking of some examples on Shark Tank as well, but you definitely need a plan on how to spend it. Whenever you're building out a startup, the $100,000 you get for an investment, pre-seed, is actually not that much. And you can honestly burn through 100K in less than a year. And really, you need a high trajectory. A lot of the investments you'll be getting won't be an accurate representation of your your total valuation. I'll talk a little bit more about convertible notes in a little bit, but the money that you get oftentimes does not transfer to equity immediately. And then the reason why it's been 5 to 10 years, either you're going to be exiting as in you're getting acquired, or if you really want to shoot for the stars, you'll be IPOing, meaning that you'll be listed as a publicly traded stock where anyone from the public can buy it. So why wouldn't you want to raise money? Bootstrapping. So if you really want to build a business from scratch without raising external capital, that means you can own the entirety of your startup. And if you don't really need the money, then it's not necessary. Oftentimes, that's something that comes with raising money too, is that you get increased social capital. You'll get increased amount of connections and networking opportunities. But if you, one, feel like the money isn't necessary, and two, you're already pretty well connected with VCs, angels, then you can just hold this off for a while. So it's also best for companies that burn capital slowly to achieve consistent growth. So if you have $1 million, right, and you are basically hosting all of your services for free already, and it's a very low maintained startup, then you don't need to raise capital. It's better for you to keep going down your line, keep the 100% equity, and raise in the future. Some examples of startups that are generally low maintenance. I know Instagram at first was a very low maintenance startup. It was basically just a file sharing website where you uploaded something, and other than that, there was not that much from a support side. You did not need a fully fledged user support system. It was literally just viewing files of videos and photos. So that would be an example of a very low maintenance app in the past. Now today, it's more than just Instagram. There's so many other features on it now. So there's that. A high maintenance app I can think of would be something like YouTube, right? The difference between YouTube and I believe Instagram is that videos needed to be heavily maintained, and today YouTube has so many other sectors such as YouTube gaming, YouTube Live, and nowadays that is a very, very high burn. Twitch was also another example of a startup that burned through a lot of capital very quickly. And also allows you, like I said, to maintain full ownership, but be careful, this is a trade-off. If investors can help you scale, if you are worth $1 right now, only 100% of that $1 is worth nothing. But if you can scale 1,000 times to $1,000, then you'll have 50%, let's say, of $1,000 is $500, which means that you personally increased your valuation by like 500, like to $500 if you exited at like $1,000, for example. So what is startup capital? There are two ways of really raising money. One is debt, and the second way is equity. So debt is, as it implies, you can go up to a bank and take up all like 200K and pay it back, right? What you can also do is give up equity for a portion, equity, which is a portion of your company, for money as well, right? So let's say I own like a lemonade stand, right? Let's say like Bob comes over to me and it's like, I don't want to give you money just for like, debt. I actually want to own a portion of your lemonade stand. So let's say I'll give you $100 for your lemonade stand, but I'll take a 20% equity. If I give you 20%, or if I give you $100 for 20%, that basically values your startup at $500, or that lemonade stand at $500. So what would be the point of taking equity then, right? Like I paid like $100 for 20%. Under that equity, you'll have a few ways of making that money back. One, you can make your money back once that company or startup liquidates or exits. So that's either through IPOing or getting acquired, like I said. And I'll talk a little bit more about this in a little bit as well. But also the second method is on dividends, right? So if I am the lemonade stand again and I sell each like glass of lemonade for like 10 cents, at the end of every quarter, I can tally up all my earnings, and a certain share of that earnings will go towards paying off my investors. So that's essentially what a dividend is. Startup capital is also like financing for high potential and early stage companies in exchange for equity. Almost all startup capital is oftentimes in something called a SAFE, which was created by Y Combinator. It's a simple agreement for future equity, and I'll run through an example of how SAFE notes execute and how they're created in a little bit as well. So I'm going to go over a few of the investor types. So the first one, which is, I'd say, like very common just starting out, these are like investments in the range of like $0 to $150,000, and they're typically entrepreneurs, friends, family members, and these sort of investor types can range from a seed stage investor to something called pre-seed as well, and they're risking relatively small amounts of capital with honestly like a high prospect for failure. It's basically like a shotgun method. Like if I invest 10K in 100 startups, one is bound to be successful at one point. And they will invest in very, very early stages of a company. They'll be oftentimes leading investments, meaning that they will be the first investment to a company and take a high percent share of that company as well. And they really tend to be like investing as a hobby. Like they are really just throwing their money at the wall and seeing where it goes. But most of the time, they aren't expecting that money to be back. And they're also super angels, which is sort of like a bridge between angels and institutional capital. Sometimes like these super angels can really like invest anywhere from like a couple $100,000 to even $1 million. I know like Elon Musk in 2011 or 2012 or something invested, I don't know, like over $1 million. I forgot the exact amount into Stripe. So that could be an example of one person investing a high amount into a startup. So the next type are VC funds. These are organizations which collect capital from LPs or limited partners, and they take the money from LPs and invest that into companies that have a high potential for incredible growth. So some example of LPs would be like high net worth individuals. At contrary, we have like a numerous amount of LPs from the founders of like large companies from like Twitch, Facebook, Airbnb. And then, it can also be family offices, like university endowments, nonprofits, and insurance companies. So a goal for a VC would be to basically go in these funding rounds where like I spend like a year or two going around collecting money from LPs, Then after I raise, let's say like for example, like $10 million for my first like funding round, I'll start investing it. And usually you want to keep like a good amount of your funding round, the money that you make from your funding round, to invest over the few years afterwards. And then after those pay off well, you do a second funding round where you can get more money from LPs, and oftentimes you'll like contact your LPs again and be like, oh, we're doing another funding round. We're going to invest in more startups in the next few years, but for a higher amount of equity, or like it'll be for like a Series A this time. And then you'll just keep doing that over and over again. And yeah, the math only works here if you shoot for like 1,000 times. You're really, really investing on these startups that are literally going to go like 1,000 times growth. And the most famous examples of these VC funds will be Andreessen Horowitz, Kleiner Perkins. And as an aside, there's also something called like growth equity funds, like Summit Partners. These are funds that invest into not even startups, they invest into established companies. Summit Partners has invested in like notable companies that are like 10 years old, like multi-decade like old, and typically these growth equity funds would invest into companies that are planning on doing a restructuring or horizontal integration in some way. These are for companies that they believe are going to make a massive change, although already established. The next investor type are syndicates. Syndicates are a collection of investors investing into a single company together at an early stage. So what often happens is that there will be a lead investor, becoming like the entrepreneurs like evangelists, and a firm can focus most of their energy in pursuing and capturing like a lot of that, and then they'll have other people follow along as well. So you have a lead investor and you have those following VC funds, angels, to raise an additional amount of capital, right? So I can provide an example for this, right? So let's go back to my original lemonade stand example, right? So let's say now I go on to my next round of funding. My lemonade stand is worth like $1 million. Now let's say like a VC fund like Sequoia comes around, right? And they want to invest like $500,000, but they feel like this could be a greater opportunity to pour in even more capital, and $500,000 is really the most they can invest at that time. They'll go contact other VC funds or angels to invest an additional $250,000, so that the total investment as a syndicate is $750,000. So oftentimes syndicates will arise when a leading VC fund thinks that the amount of capital is not enough, and they could accelerate the startup's growth even more by pouring in even more money. The next type are seed funds and accelerators. These also raise money from LPs, so limited partners, and they invest solely in small companies with also, again, like large growth potential. And oftentimes they'll often have like this unique value proposition of help and capital, but really emphasize the help in exchange for equity. Some run accelerator programs, which are generally like a few months long, and they'll really be there to mentor and teach companies. And at the end of like the few month program, there'll be a demo day. Some example of seed funds accelerators would be Contrary. At Contrary, every summer there is a semi-month program where startups come together in a physical space. They get mentorship, they get workshops. At the end, there's a demo day. Famously, there's also Y Combinator. Y Combinator will take 7% of your startup, give you $150,000, and put you in a like 3-month-long program over the summer or winter, and just teach you and just make you like work nonstop on your startup in hopes that will succeed. And then on demo day, a bunch of investors will come in and invest into your company potentially. So I'm going to go over sort of like the different funding rounds now and how much it costs and what sort of goes down and why some companies will skip these or take these on. So in pre-seed, it's typically like 50K to 500K, and seed nowadays will be 500K upwards to even 4 mil. Pre-seed, you can also classify underneath that as like angels, family and friends. And this will be the first time that you will be offering equity for the funding that you get. Oftentimes at this stage, your product market fit is also not completely figured out. I believe ASIM Innovate had like a workshop on product market fit, so I recommend you checking that out. But this is initially when you've demonstrated customer interest. So you're really just carving out like some stake, figuring out like what your competition is. But at that given point, you don't really know whether this startup will succeed still. And obviously this bar varies a lot by the industry, but at these funding rounds is really just about mitigating risk at this point. Like most of the money that comes out of pre-seed seed will not be successful unless like it is, I don't know, from a very successful like angel or like pre-seed or seed VC fund. A lot of family and friend investors are really just throwing their money at the wall again and just not hoping for much. But it really supplies you with the capital for building like really the foundation for a profitable business. A lot of accelerators such as Y Combinator and Contrary will give you access to credit for AWS. They'll give you a pathway to getting incorporated through like Stripe Atlas, all that stuff. And they'll typically be used for early needs like hiring team members, market validation, and deploying MVPs. So after raising a seed round, you go down the list of Series A. So Series A now ranges from 2 mil to 15 mil. Every single year, this amount goes even higher and higher. So this will probably change in a year or two. But this is when you're building a team, launching the product, and really finding product market fit and carving your stake out in the competition. Series B is 30 to 60 mil. Is when you're expanding your team, expanding the product, and exploring the verticals as well. Series C is 30 mil to 100 mil, and that's scaling even more. And then Series D plus, it can go on to like FG even more. This is international expansion and growing to adjacent markets. After like you sort of reach a Series D, you go into a pathway of like IPOing like a few years down the line as well. But oftentimes companies may wait like a few years or even like a decade to even IPO as well. So this will be like the fun part of the workshop now, and it is how equity and stocks work. So there are two stock classes. There is a common and preferred stock. Oftentimes when you are getting investment from a VC fund, you will be getting preferred, or the VC fund will be getting preferred stock. Preferred stock has no voting rights, but has a higher dividend yield, and the VC fund will be paid first on liquidation. I'll explain this in a little bit, but common stock is a little bit different. Common stock has voting rights proportional to the amount of shares that you have. They'll typically have a little bit lower of a dividend yield, and they will be paid last on liquidation. What this means is that if a company exits, right, or they go bankrupt, or like they sell for a very low amount, the VC fund will get their payout first over the common stockholders. So let's say I am my lemonade stand once again, and I sell for $1 million. And me as the VC fund, I invested 500K. I will get that payout first over the common stock folks. So this might lead to a situation in which all of the VC funds get paid first, and then that means nobody that has a common stock will get paid out. And I'll talk a little bit more about liquidation preferences in a little bit as well. But just know that most VC funds will prefer, or almost 100% of the time, be getting preferred stock, because if that company exits, they'll get paid first. And generally speaking, just having a higher dividend yield is more reliable over common stock, which is mostly going to get profits on like realizing like capital gains. So lower dividend yield. This is the stock that you'll be getting on like publicly traded. Also, when you're getting an investment, something to really realize is that you as a founder don't sell or transfer any shares that you have. So this graphic sort of like illustrates it, but I'll go a little bit more in depth into it. So let's say you as a founder, have 50%, and your other investors make up that other 50%, right? So you have investor 1 who represents 25%, and you have investor 2 that represents another 25%. When somebody invests into your company, you don't say, oh, I get to have this share of the slice, or you get to have this share of the slice anymore. That's not how it works. What you actually do is you say, oh, let's just add additional shares into the company and dilute ourselves. So what you do instead is say, oh, in this sort of share of the pie, you'll add this amount of stock in right here, and it'll become this share of the pie, where investor 3 gets 200 additional shares. So I know this is a little bit complicated, so I'll spend a little bit of time just drawing this out. And if anyone wants to interact in chat, they can, but all good if you don't want to. So let me clear this really quickly. All right, so let's say I have a startup called cat.io, right? And let's say I have 2 founders here. I'll have me and I'll have my friend here. We'll call him Bob. Excuse me for my poor drawing. And we have a 50% split. And let's say we both have 500 shares. And let's say this investor comes in, right? We'll call the investor Jill. Jill wants to invest into the company, and let's say she wants to pour in $200,000 for 200 shares. Me and Bob aren't going to give up each 100 shares of our company. What is going to be happening is that 200 shares are going to be added to the company at the end. So at the end of the day, what it ends up looking like is, oops. Let me put this here. This is what the sort of breakdown looks like. I'll have 500 shares here, split 500 shares here, and then 200 shares here for a total of 1,200 shares. So this is Jill, this is me, and this is Bob. So what is the percent ownership that Jill has in her in the company right now? It is 200 over 1,200, which is, if my math can do poorly right now, my math is kind of brain dead right now, but it is 16.6% of the company. So what does that mean for me and Bob? So Jill has 16.67% of the company. Both me and Bob now have 41.6% of the company each, but that still means we have a majority share. So that's generally how dilution works. You never ever transfer your shares or sell your individual shares. You always add, and you always dilute the amount that you currently have as a founder. So hopefully that made sense. I know it gets a little bit more complicated, but that's sort of the best way of explaining it. I'm going to go on to the next slide, which is the most common way of investing into a startup, which is a simple agreement for future investment, or future equity, I mean. But in order to understand what a SAFE is, you need to understand what a convertible note is first. So it's basically a note saying that I will invest X amount of money now, but I'm not going to take any of the equity of it. What I'm going to do is that on your next investor, I'm going to convert it based off that equity, right? So I'm going to do a quick example in a little bit, but it also has something called like a maturity date. So like, let's say me as an investor, right? If I invest into a company and I give them $200,000, in 1 year down the line, once it reaches a maturity date, if no one comes in to invest, that means it doesn't execute, and it executes on the maturity date, which I have 2 really like choices to make at this point in maturity date if there's no outside investment. I can, 1, decide to convert the amount of money to an amount of equity, or 2, demand payback from that startup. And this will oftentimes come with interest and a discount on next investment. So I know once again, this might be a little bit complicated, so I'll be bringing out the whiteboard one more time. So let's clear this out really quickly. So let's say we have that 50-50 split again. So it's me again and Bob. We both have 500 shares of this company. Let's say now Jill wants to give me a convertible note of 200K. That 200K will not execute immediately, meaning that Jill will not have any equity into the next funding round. So let's say now that, let's pick a new name. Let's say that Joe comes in, right? And Joe, like 4 months after Jill invests, says, I want to invest 500K, right, for 500 shares. What's going to happen is that this will execute, but only after Jill does first. Because Joe decides to evaluate the company at 500K for 500 shares, that is the precedent that Jill's contract will execute at. So I would like drawing this out, but this gets a little bit more complicated. Just know that a convertible note is basically amount of debt that will convert to equity in the future. Also, safes are basically a convertible note that's just a little bit more simple. They can come with a valuation cap on the following round. So if somebody comes in to invest, if they basically can get a cap on how much that startup will be valued at. And there's also like no interest or maturity date compared to a convertible note. There's also some other things to note about term sheet conditions. When you're handed a term sheet, which is basically a VC fund saying like the amount of money they're going to give you and the really legal precedent of them investing into your company, there are some other conditions that come with an investment. There's something called pro rata rights, which means that when you invest into a company, if another investor comes along, do you notice how your share as an investor gets diluted? So investor 1 here, right? When investor 3 comes along, that investor gets their shares or their percent equity of the company diluted to 20%. What ends up happening under pro rata rights is that me as an investor, I get to keep my 25% by investing an additional amount. So what I can do as an investor with pro rata rights is that I can maintain my 25% stake in the company by investing an additional amount of money and diluting the amount of equity that the founders have, but not necessarily mine. So this is just a way to keep your investors, active in the company, and also for them to really help out in the long term. Because like if I as an investor come along your seed round and give you a bunch of money, like a few like rounds down the line, I'm going to lose a really large percent share of my company just because you keep raising a bunch. So pro rata rights means that I can keep the amount of share that I have in future rounds of funding. There's also something called liquidation preference. So what that means is that if your company exits, whether that be acquired or like going bankrupt, you have a guaranteed amount of money back. So let's say like you invest $1 million to a company that sells for $10 million, you have the right to getting $2 million back on a 2.0 liquidation preference. You don't have to execute this most like all the time, but let's say a company goes bankrupt, right? And they sell for $900,000, right? And then now you have a 1.0, like a 2.0 liquidation preference, which means you are guaranteed a $2 million return. If that company sells for $900,000 and there are no other investors, you get to keep all of that $900,000 that it sells for. And this gets, once again, a little more complicated down the line, like with more investors. Basically, the way liquidation preference goes is that the newest investor usually gets the order of preference. So like somebody in a seed round will have the last on the liquidation than somebody in a Series G. So somebody in Series G who has liquidation preference will get their payout first before somebody in seed gets their payout. So it usually spirals down to the bottom. And there is also there are much more conditions such as pay to play, which means that everybody who invests must execute their pro rata rights in future rounds of funding. And there's also something called most favored nations, where you get to keep the term conditions of the next round of funding if you have no specific conditions specifically on your round of funding. But all these term sheet conditions get a little bit more complicated the more you go down the line. So it does get a little bit more complicated, so I won't go too in depth, but I think this pretty much wraps it up for the workshop on how funding works. I know that this workshop is a little more convoluted and a little more hard to understand, but I really recommend, if you want to learn more about investment, just reach out to me at stanley@contrarycap.com. I know some workshops that I sort of looked at, or some YouTube videos that I looked at to understand how equity worked, was under the YouTube channel called Slidebeam. They have a really good series on how equity works and how funding works. But I completely understand if you got a little bit lost starting from here on to the next 2 or 3 slides. It takes a little bit of time to wrap your head around on how equity and convertible notes and safes work, but hopefully this was the first time you're hearing about this. And if it's your first time about you hearing this, that you take a deeper look into how this works and just understand a little bit about how investment works at a very basic level. So, well, other than that, I think that pretty much wraps up the workshop. Thanks for coming to the two-part workshop. I hope that you enjoyed this, and hopefully in the future, if you're watching this, there'll be more to come. But I'll stop the recording now.